Hello and welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. My name is Brad Wilson, financial advisor with KLT Wealth Management, and today is November 25th, 2020, and I am here with Season 2, Episode 5 of our podcast. Today is a special episode. We actually released an episode last week. If you haven't yet heard it, we did a post-US election follow-up and dove into kind of the December market outlooks. But today, very happy to have a special guest join me on this podcast. Greg Bracken, who's a mortgage agent from Capital Mortgages here in the Ottawa area. Greg, thanks so much for joining me on the podcast. Really excited to have you here today.
Yeah, thanks so much, Brad. It's a pleasure.
Awesome. So to give our listeners a bit of a sense of what we're going to dive into today, just a general sense of where the real estate market is here in Ottawa, and then a general sense on what's the mortgage pre-approval process like? What does it take to get a mortgage? How much can you afford? What is the, going into getting approval, post-approval, buying a home, all the different ins and outs of the mortgage process. What are the rates? How do rates vary? So there's lots of questions that we're going to dive into today, but I think it's important that we start off with kind of where are we at right now? So Greg, what's the situation like here in Ottawa when it comes to the real estate environment?
So I mean, as far as real estate goes in Ottawa right now, it's sort of it's a very active market. As I'm sure a lot of folks are aware, prices are on the rise month after month. And right now, so the sort of stats that I'm working with are based on October's numbers. And right now, the average single family dwelling for a freehold home in Ottawa, about 654,000, which is a 21% increase over October of last year. And for a condo, the average price sitting around 379,000. So, and that represents about a 15% increase. So, as far as sales that happened in October, just over 1,500. So you can see it's a very, very active market, and the average time on market for a freehold home is 14 days. So things are moving very, very quickly, and all of this while the number of listings it has gone down to 577, which is a 75% drop over last year's numbers. So lots and lots of movement happening, lots of pressure in the market. An overall lack of supply, it kind of seems to be the story that's being told by the numbers. Lack of supply driving the increase in prices. So.
Yeah. So in general now, we're still the markets haven't really slowed down. Is that what we're kind of getting from October's numbers? Is because throughout this year, we've seen that ramp up, right, of the homes and aggressive biddings and everything like that. Is that the kind of where we're still at right now? Nothing's really changed. It's still kind of status quo from that standpoint.
Yeah, that's exactly right. So you're still seeing bidding wars, people going in, without conditions, putting down, offers that are over asking. Absolutely, kind of still things very, very busy on that front.
Right. And what's the mortgage rate environment right now? When we talk about getting a mortgage, oftentimes the interest rate is one of the biggest deciding factors. Where are we at right now? I know a lot happened this year that kind of drove rates down. Are we still there? Are we at a low point? What's the situation right now with rates?
Yeah, that's right. So you're absolutely right. Over the last little while, everything has sort of, rates have gone down. We're at a historic low right now in terms of interest rates. The reason for that is that we're just trying to essentially stimulate the economy by encouraging spending. So, interest rates are very low right now. Obviously, that's going to, the specific interest rate for yourself that you might qualify for is going to change based on your specific situation. But for a high ratio mortgage, right now, rates looking as low as 1.64%. And if you're looking to refinance your home, to do a reno or take out some equity, looking as low as 1.99%. But obviously that's sliding scale, and there's no indication necessarily that things are going to move up or down. But that's kind of where we're sitting as of today.
Yeah, awesome. I think, personally, just from an opinion standpoint, I think the low interest rate environment has definitely amplified the spending when it comes to home purchases this year, right? With these low rates, everyone wants to either refinance their mortgage, buy an investment property, buy their first home now and lock into, a rate for a long period of time. Is that kind of the sense you're getting as well with where we are right now?
Yeah, for sure. That's exactly right. And then not only that, like to just kind of build on what you're saying, changes like, renos to put a home office in or move to a spot, out
Right.
of the downtown core with a little bit more space. You have one party, two parties sometimes looking for now a home office that they can work in feasibly. So lots of sort of changes in what the sort of is driving consumer demand right now.
Yeah, I'd be curious to see, actually just kind of sparked my mind with new home builds, right? If you're going to see a lot of the designers start implementing home offices into a lot of, even, think of townhomes, right? If they say it's a 2 bedroom plus an office or a 3 bedroom with an office, right? Like that's definitely a need that I think a lot of people have realized. And if they were in a smaller dwelling before and they could afford something larger, now is the time to move, right? With the low rates. So
That's right.
yeah, that's
That's right. Yeah.
fascinating.
Yeah.
Awesome. So I think that's a great, real summary of where we're at right now when it comes to the Ottawa market. I think it's time to dive into the pre-approval process. What's it look like, Greg, if I want to come and get a mortgage? What's it like working with an agent, and what's that pre-approval process like?
So as far as the pre-approval goes, it's largely considered to be the first step in the home buying process. And the reason for that is it's what gives you the ability to know exactly how much you can afford. It also guarantees you a minimum interest rate that you can be that you're going to be responsible for when you have the mortgage secured. And it lets the realtor as well as any sellers know that you're a serious buyer. So it kind of signifies, hey, I am ready to start looking at homes, and in the next X amount of time, I'm exploring the option of making a purchase here. So
Right.
the benefit of that is really just to sort of to kind of unpack that a little bit, is when you have a pre-approval in hand, a lender is going to guarantee you an interest rate from that pre-approval for the next 120 days. So really it sets you up for success. It's a great tool to have under your belt while you begin shopping. Because you know exactly what you can afford and you're being held that rate for 120 days.
Yeah. So in order to get a pre-approval, what kind of documents do you need to bring? What qualifies me to kind of submit an application for a pre-approval?
So we're looking at a couple of different things, and the main things are essentially looking at, okay, verifying your income to make sure that you can support the mortgage payment, as well as
Mhm.
verifying the source of your down payment and closing costs. So
Okay.
to verify your income, lenders are going to look at your last 2 years of T4s or notice of assessment, as well as 2 recent pay stubs. They're also going to look at, to verify your down payment and closing costs, they're going to look at 90 days of your bank statements to kind of just make sure that you have that the ability to put the resources down for a down payment and closing costs. And just to kind of touch a little bit further on down payment and closing costs, a lot of folks are under the impression that, as soon as they have 5% ready to rock and roll for their down payment, that they're ready to go. In actual fact, what's happening here, lenders want to make sure that you have the funds required to complete the transaction as well. So, things like legal fees, land transfer tax, which as a first-time home buyer, you are entitled to a rebate, but you do need to have to show it prior to the purchase,
Right.
as well as a couple of other miscellaneous things that are included in that. So when you're looking at minimum cash required to enter to purchase a home, what you're actually looking at is 5% down payment as well as 1.5% in closing costs. So to give the
Okay.
example of a $400,000 purchase, you're looking at a $20,000 down payment as well as $6,000 available for those closing costs.
Right. Yeah, I think that's important to know that, like, you need to have some money set aside. Those lawyer fees, it can add up, right? Like all those additional expenses, and then just ensuring too that when you're purchasing that home, it's the property tax, the mortgage insurance, all those things that go along with that home buying process, that you're set up when you're getting settled, right?
That's right.
So yeah, so that's great. I think one of the questions that I think people have too is, and some often are worried about their credit score, and is their credit score good enough to get a mortgage, and what does that factor into in the pre-approval process there?
Yeah, that's right. And that's definitely a very important factor to consider. So, for example, if you have now your credit score doesn't necessarily impact the amount of funds that you qualify for. What it does impact is the rate that a lender is willing to give you those funds at. So, if your credit score is anywhere above 680 to 900, 900 is literally perfect. Anywhere above 680, you're sitting in a fantastic position to qualify at best rates. Anywhere under 680, you're sort of in a position where a lender's going to look at and say, you know what, there might be a little bit more risk involved here. If you have missed a payment or two in the past, whatever that looks like on your end. And that's going to essentially have an effect on the interest rate that they're able to offer you.
Okay. And now with a pre-approval, they do go and do that hard credit check to ensure they're looking at the right thing and getting your credit score. Does that impact, say my credit score if I am doing a pre-approval process in a negative way?
So there's a little bit of that's a really good question. So essentially it might have 1 or 2 points, maybe 3 points off of your overall credit score if you are to get a hard pull done. And I mean, really 3 points in the grand scheme of things is a very negligible difference. Now, where I see a lot of folks that will come to me, if they're shopping around and doing their due diligence, as I recommend everybody does, asking, what they may be able to qualify for, and looking to get a pre-approval done. So, in the event that you're shopping around and you're having 2 or 3 or 4 different people pull your credit report, those are what's considered soft pulls. So each subsequent pull when you're shopping for a mortgage, or if you're shopping for an auto loan, et cetera, is not going to have a negative impact necessarily on the overall credit score, because each subsequent pull is just considered what's called a soft pull.
Yeah, I think that's a misconception is a lot of people are really worried about their credit score being impacted when they are, shopping around for rates or anything like that. So it's good to know that, double check, see if it's a hard check or if it's a soft pull. And even if it is a hard check, and you've got a relatively good credit, the 1 to 3 points really won't make a huge difference in the grand, as you said, in the grand scheme of things. I think it's good to kind of, we'll roll it back a bit and just say, look at the full pre-approval process. What's it like going through, working with either an agent or a mortgage specialist? What does that process look like when it kind of from start to finish when you're looking to get approval for a mortgage?
Yeah, so we have a super, super handy online application form. So essentially what the process looks like is you would fill out the online application form, and at which point we're going to have a 20, 30-minute discovery call where we talk about, okay, what are your goals? What are your expectations here? What can you reasonably afford based on your current income? A lot of folks, say, a lot of folks come to me and think, okay, I want a $380,000 mortgage or a $400,000 mortgage. But when you break it down as far as monthly or biweekly payments go, it's okay, does that look feasible in comparison with your goals, long-term, short-term? So how can we sort of address your expectations and your goals? And then moving on from the discovery call, we look at collecting all the documentation that's required for a lender to review and process the file. And we'll submit everything to a lender. They're going to take 2 business days, usually, is the sort of service level agreement that most lenders have. And they're going to ship us back and say, okay, yep, Brad is approved for X amount at this interest rate for the next 120 days. So the commitment will work in a way that says, that guarantees you that rate for the next 120 days while you shop. Excuse me. And when the time comes that we are, when you've got an offer in on a place and that offer has been accepted, we're going to resubmit everything as a total package. We're going to shop around to all the different lenders again to see who's offering the best rate, the best terms, the best overall package, the best solution for yourself at the time of your purchase. And we'll work to submit any other documents that they might need. And from there, we're going to have an approval. The approval, will be shipped off to your lawyer. Everything is going to be signed, and you guys will be homeowners in no time.
Beauty. Make it sound real easy, Greg.
Yeah,
You
yeah,
make
yeah,
you
yeah.
make the whole process sound real easy, which is awesome. But the home buying process can, as I think many people know, can be very complex. But it's good to know that there's that kind of clean process when it comes to getting that mortgage pre-approval and then getting it a firm approval once you've secured that place.
That's right. And I think the home buying process can be very intimidating, very convoluted. So, I mean, my goal in my interactions with my clients is to take a look and say, okay, how can we break this down? How can we make it make sense for you? And sort of bridging the knowledge gap, because that's a huge barrier to entry for a lot of folks, is just not being sure what to expect throughout the duration of the transaction. So that's something I sort of keep close to my chest as we sort of navigate the process together.
Yeah, absolutely. And I think just as from a financial advisor's point of view, the first thing you talked about was, some people going in with, I want a $300,000 or $400,000 mortgage. And then it's actually getting down to, okay, what's it going to cost you per month? What's it going to cost you in weekly payments? And I think that all ties back to cash flow planning. And I think one of the big things going into the home buying process or the mortgage approval process is, sitting down with an advisor, making sure you've got that cash flow planning. So, I can afford X amount per month, and tying that in with your income, with all of your other expenses. That's an important step as you enter the mortgage approval process. So yeah, just it's something that's really important, especially when you're making probably the largest purchase of your life with a
That's
home,
right.
right? So it's
Absolutely.
important to know where you're at and know what you can afford when it comes to the actual payments that you're signing up for.
Right, right. And just to sort of close the loop on that, I think it's important. So I know a lot of folks will go, have a pre-approval done with a broker or a bank, and not. There's a bit of a difference between sort of a pre-qualification and a legitimate pre-approval. And the danger with the pre-qualification is that an advisor at a bank or a specialist or an agent might say, okay, based on your income, here's what you can qualify for, and maybe not always taking into consideration, okay, what sort of monthly payments are we factoring in there, right? So they may or may not look at, if you have a $350 a month auto loan or student loans for $120 a month or a balance on a credit card, those things all play an important part of what you can qualify for in terms of mortgage value. So it's very important distinction to ensure that you're getting yourself a legitimate pre-approval that takes into consideration the full picture, as opposed to just the pre-qualification where they're only looking at your income. So just to kind of, as I say, close the loop on that.
For sure. And correct me if I'm wrong, but a pre-qualification doesn't tie the lender to committing to giving you those funds at set rate, right? Like the pre-qualification is just giving an idea of what you could afford, whereas the pre-approval is saying, yeah, as a lender, we're committing to giving you X amount of mortgage funds at this rate over the next 120 days, right? Like that's the difference there.
Yeah, I mean, so the pre-qualification, it doesn't say you can, it says you can afford X amount, but doesn't take into consideration the other monthly payments that you have. So given the example for just to sort of break it down a little bit, given the example of somebody with an $80,000 income, they may be able to qualify for, without any other monthly payments, they may be able to qualify for about $375,000 mortgage. With that, using the example of the $350 per month auto loan plus $120 a month student debt payments, the amount that they actually qualify for would reduce to about $350,000 or $351,000. So it's very important to have the full picture, and because it does play, there is an impact there on your the amount that you're able to borrow. Now, right. The other piece that you touched on there is, okay, so is this an actual commitment from a lender to lend you the funds? With a pre-approval, it's important to remember that nothing is set in stone. So it's always conditional based on there being no material change to your financial position. So if you're to go out and take on an auto loan, or, have a balance on a credit card after that, then that sort of it. So neither are legally binding from any perspective, but one of them just takes into account a little more full picture of exactly what you're looking at.
For sure. So pending nothing changes with the pre-approval, they've already looked at everything. So they've got the understanding of this is what you can afford based off of all the different
Right,
factors.
right. And it's, yeah, so it's a reasonable assumption that, hey, yeah, you would qualify for X amount based on there being no material change. That's right.
Yeah, that's really important, and I'm glad we kind of discussed the difference, because pre-qualification is something that's out there. It's something that people, I think, can get really easily by filling out a questionnaire online or filling out something online. So it's important to know the difference, and why getting that pre-approval is much more valuable when searching for a home, and much more accurate when you're trying to understand what you can afford. But I do want to go back. One of the things you touched on was mortgage specialists, bank agents. What are the difference between, say somebody at one of the banks that you might go see to discuss a mortgage versus a mortgage agent? Where's the difference come into play here?
Yeah, so essentially the main difference to consider when you're dealing with a mortgage agent. Mortgage agent is somebody who, like myself, is independent agent. So we have relationships with, our firm used 53 different lenders last year. So we're able to sort of provide a broad range of products and really tailor a solution to your specific needs, as opposed to a bank, which only has access typically to its suite of products. So they're only able to,
Right.
so if you go to TD Bank, for example, they offer TD Bank products, whereas, I can look at a range of different lenders and say, okay, this is what makes the most sense given your situation.
Okay. Awesome. Yeah. And I think that kind of touches on a thing I do want to go into is different products, because each lender offers different things with each of their products, and that can include different rates, that can include different types of rates. I do want to touch on variable and fixed rates, and so what do you kind of look for, and how do the products really differ from different lenders there?
Yeah, so it's going to depend wholly on, what I mean, taking a look at a case by case basis, kind of what makes sense for the individual.
Mhm.
And as far as differences go between fixed and variable, it's relatively straightforward. The fixed, just as it sounds, if you sign on to a 5-year fixed rate, what that means is that, say your interest rate is 1.69%. Well, what that means is that your interest rate is going to remain the same throughout the duration of that 5-year term. Whereas in
Mhm.
a variable rate mortgage, you're actually looking at, okay, rates are going to go up or down. Are rates going to go up or down throughout the course of my term, and what impact does that have on my payment? So I think it's important as well to remember that the amount that you're paying on a monthly or biweekly basis doesn't change between variable and fixed. So if your monthly payment is, say, $1,800 a month, whether at the beginning of your term, that's exactly what it's going to be throughout the end. The distinction is what portion of that payment is going towards principal versus interest. So
Okay.
that remains static on a 5-year fixed, or on a fixed term mortgage, that remains static. Whereas on a variable rate, that might fluctuate.
So what exactly goes into calculating the variable rate? How is that kind of tracked? Where does that number come from?
Yeah, so the variable rate is directly linked to the Bank of Canada rate. And what that means is, if, and the Bank of Canada is essentially, it's going to adjust either up or down based on the overall state of the economy. So right now, as we've seen, coronavirus take a hit on the economy, we're seeing that overnight lending rate diminish or decrease, and kind of hold strong at a very low rate. So variable rate mortgages are directly tied to that.
Yeah. We talked about it many times on this podcast this year about the rates being slashed. It's been widespread, obviously, with everything going on and the attempt to stimulate the economy. But that's good to make that distinction. And good to note also, I think a really important point you did mention was that your payments don't change when you've got a variable or a fixed. It's the amount of interest you're paying. And I think that's a really important thing to understand when you're looking at the different rates. I think to circle back to one of the things we kind of discussed when it comes to the pre-qualification is what can people do to figure out how much exactly they could afford when it comes to a mortgage, just to get a general sense. Maybe not ready to go through the pre-approval process yet, trying to get a general idea of, okay, maybe how much could I afford right now? What's a good strategy for them, or are there tools out there that they could use to get maybe that pre-qualification?
Yeah, that's a really great question. So there's a number of online resources that you can use to sort of determine your affordability. I have a brand new calculator on my website that shows the affordability. That's at brackenmortgages.ca. And anytime, if you'd like to chat and just sort of, I'm always available. We can run the numbers and kind of take a peek and see what you'd qualify for sure.
Is there a general like rule of thumb, like it's X times your salary? Like, is there a general, obviously we talked about it before, the other debts you might have, student loans, car loans, credit card payments may affect it. But is there a general rule of thumb where it can be like, okay, I'm making $70,000 a year, I could qualify for 2 times that, 3 times that, 4 times that?
Yeah, so that's a really great question. Essentially, what regulators do and what lenders do is they look at your income to debt ratio, and they show, okay, this is how much money you make in a year. This is how much of that money is already tied up in monthly payments otherwise. So based on our sort of our regulation or our guidelines, this is what you can reasonably expect to afford. So what they say is approximately 39% of your, or no more than 39% of your gross annual income can be spent on housing expense. So that includes principal, interest, taxes, and heat. And then no more than 44% of your total debt service, including any, including housing payments. So that principal, interest, tax, and heat, as well as any, student loan, auto loan, line of credit balance, credit card balance, et cetera, et cetera. So that can't exceed
and so
44% of your gross annual income.
Right, and that's your like monthly payment. So if you're paying $1,000 a month on your mortgage, for example, then $12,000 a year is kind of categorized to that portion of that. It can exceed that 39%.
That's exactly right.
Right. Okay. So that's good to know when it comes to your affordability. It's understanding it is a percentage of your gross income in that year to the expenses relative to, they call it debt servicing ratios. It services the debt, right? So the debt, the money that's going towards that debt. But one I think important thing, and something I've been asked, and I think it's not very well known, but when you're applying for a mortgage or getting that pre-approval or pre-qualification, what exactly is the rate that you're being based off of?
Yeah, that's a really great question. So essentially the rate is based off of the Bank of Canada benchmark rate, which right now is 4.79%. So they're taking a look at your income to debt ratio, your debt servicing ratios at a rate, as though rates were at 4.79%. And what that does is it provides, it's called the stress test. It provides a little bit of a buffer because rates are so low right now. It provides a little bit of a buffer for you so that, when and if rates do increase, it shows, okay, you can technically afford this mortgage up to an interest rate of 4.79%. So you can carry that mortgage if rates are to increase beyond what they're at today.
Yeah. So yeah, if you were trying to figure it out yourself and you're saying, oh, at 1.75% interest, I should qualify for more, or what, it's because they do that stress test and it is at a higher interest rate. So that's really important to note. So I think it's been good. We've gone through a lot of details when it comes to the pre-approval process, mortgages, different rates, everything like that. I think before we close out, let's touch a little bit on, we're getting very close to 2021, believe it or not. 2020 is coming to an end, and we're getting closer there. So what's the mortgage rate forecast look like? What is kind of the outlook there for 2021?
Yeah, so it's going to depend, I think, on a couple of different things. It's going to be tied in directly to, as we begin to see economic recovery trending towards recovery in 2021, how things are, as we touched on earlier, because rates are tied to where the economy is at in general. As we start to see the economy recover, we may see rates begin to rise. Now, I don't think that they're going to shoot up anytime fast, but over the course of the next 12 months, as we kind of get into that recovery period, I do think that they will begin to creep up. As far as an exact rate, I can't really speak on that, but I think that it'll be sort of and that's always the funny one too, is if only I had a crystal ball, right? To kind of see,
Right,
see it in
exactly.
the future. But no, I think we'll start to see a gradual increase as the economy begins to recover.
Yeah, I agree. I think it's definitely going to take some time, and I think it's all dependent on how quickly this we get under control, vaccine, all that sort of that news, and it could take more than maybe next year. It doesn't happen next year where we see a hike in
Right.
rates, right? There is that possibility.
Mm-hmm.
So we could be in this environment for a little bit longer. It could not, maybe not as long as we expect, but again, a lot of it is dependent on these factors. So this has been great, Greg. Thanks so much for joining us. Before we head out and close this off, is there any sort of tips you've got for anyone looking to buy a home, maybe looking to refinance a home? Any sort of strategies there you want to leave the listeners with today?
Yeah, for sure. I'd say the biggest tip I can give is just to kind of look at what terms your mortgage specifically offers. So, and a big part of that is your prepayment privilege. So, the prepayment privilege, how that works is essentially it allows you to put X amount, whether that's 15% or 20% more towards of the initial balance of your mortgage towards your annual payments. So, it allows you to prepay a certain lump sum. And I think it's important, right now as it stands from a sort of statistical standpoint, only about 15 to 20% of Canadians are currently taking advantage of their prepayment privileges. And I definitely think that it's something that is underutilized by most folks. And I think a lot of folks don't realize necessarily the impact that an extra $100 a month has over time. So, if you're putting an extra $100 on the back of every single payment, you can shave, 2, 3, 4, 5 years off of the life of your mortgage. So I think that's, if I were to give one sort of tidbit, is kind of if you're a current mortgage holder, look into what your current mortgage allows. If you're looking to buy one or to enter into a mortgage in the next year, take a look at, what you're offered in terms of prepayment privilege.
Yeah, no, that's awesome. I think that's a great strategy. Debt repayment and paying down your mortgage quicker, I think, is something everyone wants to do. And if there's little strategies or little benefits of certain mortgages that allow you to do so, it's a great option to have. And I think even with that, as you said, knowing how much the extra 50 or $100 every payment goes, it's the same when it comes to the investment world, right? It's the compounding and putting it on early and a little bit each time, it builds up and adds up. And if you can shave couple years off of your mortgage, you'll be debt free that much sooner, or mortgage free that much sooner. So that's awesome. Great tip. Greg, again, thanks for joining us. If people do have questions, where can they reach you? Where can they contact you there?
Yeah, so I'm available by phone or email anytime. So Greg at brackenmortgages.ca or brackenmortgages.ca. You can pop onto my website and take a look. So
I'll have all that information in the description or somewhere where you are listening or watching this podcast. You'll be able to find Greg's information. Thank you again for joining us this special edition of the podcast. We will be back next week with another podcast on our regular schedule. And as we kind of head into close out 2020, we will see you in the next episode.